In March 2023, Silicon Valley Bank was a healthy, growing bank. Within 48 hours, it was gone. How does that actually happen? Let's go through it slowly, one simple step at a time. Every bank has two sides. Assets, the money it owns, mostly loans and investments. Liabilities, the money it owes back, mostly deposits from people like you. SVB took its customers' deposits and locked much of it into long-term government bonds, very safe, but slow to sell. Then interest rates rose sharply. Older bonds paying low interest became worth a lot less. The bank's assets shrank. Now the bank owned less than it owed its depositors. In plain words, it was insolvent. News of the losses leaked out. Within hours, startup founders were texting each other, "Get your money out, now." This was the first bank run of the smartphone age. No queues outside branches, just phone taps, in a group chat. On March 9 alone, customers pulled $42 billion, about a quarter of all deposits, gone in one day. The stock, once worth over $260, was down to single digits. Regulators shut the bank the next morning. Money under the guarantee limit was always safe, that's insurance the government already promises every depositor. For the rest, regulators opened what's called a bridge bank overnight, a temporary, government-run version of the same bank, just so payroll doesn't stop on Monday morning. Days later, a healthier bank bought SVB's loans and deposits. This time regulators made an exception, even deposits above the limit were paid back in full, to stop the panic spreading. 15 years earlier, in 2008, there was no clear rule for any of this. Lehman Brothers was allowed to collapse. Days later, AIG got a massive taxpayer rescue instead. Nobody could predict who would be saved. So today there's a strict order for who loses money first. At the bottom, shareholders, the owners of the bank. They always take the first loss. Next, at 1 bonds. These pay a higher interest rate specifically because they can be wiped out if the bank gets into trouble. After that, senior bonds, safer loans to the bank that only lose money once the damage is big enough to reach this far up. And only after all of that, deposits above the guarantee limit. Ordinary insured deposits are never touched. This order was actually broken once. When Credit Suisse collapsed in 2023, its at 1 bonds were wiped out completely. Meanwhile, some shareholders, who were supposed to lose first, still received a payout in UBS stock. Investors are still in court over it. Know your deposit guarantee limit. Below it, your money is protected no matter what. Above it, you're not just a customer anymore, you're one more creditor in line.